Welcome to the Deep Dive by 5W Media.
Great to be here.
Today, we're taking a deep dive into the story of Warren Buffett. I mean, a name that's just synonymous with finance, with smart investing.
Absolutely. Everyone's heard the name.
Right. And you, our listener, you've probably seen his name, maybe headlines about Berkshire Hathaway or, those famous quotes on investment philosophy.
Definitely.
Our goal today, though, isn't just to repeat those sound bites. We want to really unpack the core stuff, what fueled his incredible journey, his unique take on business, investing, even life.
Exactly. And we've got some really interesting material to help us do that. We've looked at a biography summary from Reddit's value investing community, some leadership insights from Great Learning.
Oh, interesting.
Yeah, and observations from a university visit documented in the Journal of Instructional Pedagogies. And of course, you can't talk Buffett without mentioning the essays of Warren Buffett.
Right, the essential collection.
So our mission, if you like, is to connect those dots, really try and understand what makes the Oracle of Omaha tick.
Okay, let's get into it then. Right from the very beginning, there were signs, weren't there? Little indicators of this financial mind.
Selling chewing gum door to door when he was 6 years old.
6, yeah. It seems, like a kid's thing, but it wasn't just about the pocket money, was it?
No, not at all. That experience, buying low, selling high, it gave him a basic grasp of business. The Reddit source actually mentioned him experiencing the joy of making money.
The joy of it, yeah. Cultivating that business sense so early on.
And it ties into this whole snowball idea, doesn't it? Which comes from Alice Schroeder's biography.
Explain that a bit.
Well, it's this concept that his wealth, his influence, it didn't just appear overnight. It built up slowly, steadily, like a snowball rolling downhill, gathering more snow.
Driven by wisdom, perseverance.
Exactly. It emphasizes that it's about the long game. Accumulation based on core values, not just, quick wins.
That makes sense. And that long-term view, it's absolutely central to Berkshire Hathaway's growth story.
Couldn't agree more.
There are those two key strategies that really stand out for me. First, just that laser focus on investing in businesses he actually understands for the long haul.
Right. No chasing fads.
None of that. And second, the genius use of insurance companies.
The float?
Exactly, the float. They collect all these premiums up front, right? And hold on to that cash, the float, before they have to pay out claims.
And Buffett uses that cash, which is very low cost, essentially.
To invest and generate even more returns. It's brilliant, really.
And the numbers speak for themselves, that track record.
It's staggering. From 1965 to 2021, Berkshire Hathaway averaged, a 20% annual compound growth rate?
20% annually for over 50 years.
Compare that to the S&P 500, which is around maybe 10.5% over the same time.
Yeah, roughly. It just shows the power of that consistent, disciplined approach. It's not luck.
No way. It's a framework applied relentlessly. Makes you think, doesn't it? About our own approaches, are we looking long-term enough?
That's a great point. Are we tempted by the quick gain over that steady, maybe slower, but more reliable path?
Okay, so let's shift gears slightly. Let's talk about his leadership, his management style, because it's not typical, is it?
Not at all. Great Learning really highlights this hands-off approach.
Hands-off how?
He empowers his people, lets employees figure out problems, come up with solutions, even learn from mistakes.
So he trusts them to get it right or learn if they don't.
Exactly. The idea is it builds a stronger sense of ownership, of accomplishment.
Which raises questions maybe about balancing trust and oversight in such a huge company.
It does. He gives them real decision-making power, encourages judgment, experimentation. But he does expect results.
Right, it's not a free-for-all. He gives them the tools, the resources.
And expects them to use those effectively for sustainable growth. But crucially, no micromanagement.
He hires talented people and trusts them, lets them innovate, operate independently.
And here's something I found interesting. He believes a big competitive advantage comes from actually enjoying what you do.
Passion.
Passion as a driver.
Yeah.
It connects to intrinsic motivation, doesn't it? Doing it because you love the work itself, not just for the paycheck.
And that Great Learning source mentioned his motivation style, too.
Offering sound counsel, sharing his wisdom with employees, helping them grow, not just dictating orders.
Let's dig into some practical lessons then. That Journal of Instructional Pedagogies piece about the University of Akron students visiting him, that sounded fascinating.
Yeah, back in 2009, imagine getting to learn about business, ethics, life, straight from Buffett.
Incredible opportunity. And they toured some Berkshire companies, too.
They did. Nebraska Furniture Mart. founded by Mrs. B. Her motto was amazing: sell cheap and tell the truth.
Wow. Simple, powerful.
And Borsheim's Jewelers, too. But what really struck me from that account was Buffett's take on global markets.
What did he say?
He stressed the U.S. was still the most important market, strong recovery potential, maybe not the same growth rate as 10 years prior, but still key. But he also saw huge potential in China. Its economic system, massive population, saw it playing a big role in solving global issues. Shows a really broad perspective.
And he touched on economic policy.
He did. Acknowledged the efforts of guys like Paulson and Bernanke during crises, but pointed out it's really the Treasury and the Fed driving major policy changes.
Makes sense.
And he had this quite stoic, long-term view. Accepted downturns are cyclical. Every 100 years, we're going to have 15 bad years.
15 bad years, that's a perspective. Encourages you to be prepared, right?
Yeah.
Not panic.
Exactly. It's part of that resilience. Downturns aren't just crises. They're potential opportunities if you keep your head.
Did the students get insights into specific Berkshire investments?
Yeah, he talked about BNSF, the railroad, how it's essential, can't be outsourced, relatively green for freight, big potential out west.
And his criteria for picking companies, we hear about this a lot.
He laid it out clearly.
Yeah.
Businesses he understands, first off. Track records of at least 10 years. Positive outlook for the next 10, 20 years.
The long view again.
Always. Looking for those durable competitive advantages. The economic moats.
Like Wrigley's or Coke.
Exactly. Plus, quality management, passionate, ethical, and, of course, buying at the right price. Discipline.
That moat concept is so powerful, that sustainable edge that protects profits.
It really is. Brand recognition, network effects, patents, things that make it hard for competitors.
But interestingly, Berkshire's sheer size now is actually a bit of a challenge for him.
Yeah, he mentioned that. Finding really great ideas, big enough to move the needle for Berkshire, is harder now. There just aren't that many multi-billion-dollar opportunities that fit his criteria.
A victim of his own success, in a way.
Kind of. And yet he still digs deep. He talked about buying an old 1951 Moody's manual on Amazon.
Really? Still doing that kind of fundamental research.
Still digging into earnings growth, price per share, industry stuff. Same groundwork he did decades ago. It's about that commitment to understanding the fundamentals.
That's dedication. And finally, on this section, his values, his philanthropy, it's a huge part of the story now.
Absolutely. He credits his mentor, Benjamin Graham, and he spends real time educating students on ethics, hard work.
And the giving pledge, the commitment to give away almost all his wealth.
It's extraordinary. And his support for the Gates Foundation is significant. He mentioned believing in specialization. Bill Gates is dedicated to philanthropy. Their goals align on saving lives, so he supports that effort heavily.
He frames it as gratitude, right, not guilt. Recognizing his good fortune and wanting to give back.
Precisely. Ensure the family's okay, then distribute the rest to society.
And it's not just money. He talks about satisfaction from work, loving what you do. Happiness isn't about money, but money helps.
Yeah, it's a nice thing to have, as he puts it. He also stresses working with people you admire, maintaining that work-life balance.
Don't let work compromise family. Those personal values seem really woven into his business principles, too.
Totally intertwined. There's a real consistency there.
Okay, let's dive into some of those core principles from the essays of Warren Buffett. He sees Berkshire as a partnership, right? His own wealth is tied up in it.
Deeply. And the main goal, long-term maximization of per-share intrinsic value, not just market price or reported earnings.
Intrinsic value, we'll come back to that. And this owner focus drives how he handles capital.
Absolutely. He prefers to keep earnings and reinvest them if they can generate at least $1 of market value for every dollar retained.
Smart. Uses debt sparingly.
Very sparingly. And only issues new stock if Berkshire gets at least equal value back in return. Highly disciplined.
Transparency, too. Being upfront with shareholders.
Huge emphasis on that. Honest communication, which is why those annual meetings are such a big deal. It fosters trust, real dialogue.
And he prioritizes people over structure.
Definitely. Looks for able, honest, hardworking managers. Believes the right people are more important than rigid org charts.
Find good CEOs who don't need constant watching.
Exactly. And build a board with real business savvy, genuine interest, and that owner mindset.
That shareholder-designated charity thing is interesting, too, aligning corporate giving with owner preferences.
It's quite innovative, yeah.
Okay.
It reflects that partnership idea.
Now, he's famously skeptical of some standard finance theories. Modern portfolio theory, beta.
Oh, yeah. He dismisses beta as a measure of risk, argues it doesn't capture the real risk of owning a business.
His point being, a stock price falling sharply makes its beta look riskier.
But for a value investor, that might actually be a less risky buying opportunity.
Right. He focuses on understanding the business, its competitive advantages, long-term ownership, not short-term trading or just diversifying for diversification's sake.
And that leads to his idea of Mr. Market.
Ah, yes. The manic depressive partner.
Exactly. Market swings aren't threats, they're opportunities created by Mr. Market's irrational moods. Exploit the crazy prices, don't be swayed by them.
Which fits with his holding period. Our favorite holding period is forever.
For those truly wonderful businesses he understands, yes. Because the real measure is intrinsic value.
Okay, define that again. Intrinsic value is?
It's the discounted value of the cash that can be taken out of a business over its remaining life. That's the ultimate value, he argues, even if book value or market price are way off.
And he prefers owner earnings over standard accounting earnings.
Right. He thinks it's more relevant. Calculated as operating earnings plus depreciation minus the necessary reinvestment to keep the business competitive.
A truer picture of cash generation available to owners.
Exactly. He also constantly points out the huge benefit of compounding returns within one investment, avoiding those capital gains taxes you pay when you chop and change.
Keep it simple, let it grow, and he's thought about succession too.
Yes, he's laid out plans. A controlling shareholder, likely his estate or foundation initially, and splitting the top job, one person for investments, one for operations, planning for the future.
All reinforcing that patient, value-driven, business-focused philosophy.
Couldn't put it better myself.
What about when Berkshire does buy whole companies, mergers and acquisitions?
Same principles apply. Focus on real economic benefits long-term, not just making the empire bigger or playing accounting games.
He'd rather buy a piece of a great business than all of a mediocre one.
Absolutely. Prefers a smaller stake in something wonderful at a fair price over owning 100% of just an okay company.
Yeah.
And he's very wary of paying for acquisitions with Berkshire stock if he thinks the stock is undervalued.
Giving away more value than he's getting.
Precisely. And the quality of the management in the acquired company is critical. He wants leaders he trusts who can run things without needing constant oversight from Omaha.
And that rule about issuing shares.
Only if Berkshire receives at least as much intrinsic business value as it gives up. Firm rule.
Let's touch on accounting. He sees it as a language, right?
Yeah.
But not the whole story.
Exactly. Essential for evaluation, but you need business judgment too. GAAP has limits.
He talks about look-through earnings.
Yeah, to get a fuller picture. It includes Berkshire's share of the retained earnings from companies it holds large stakes in, but doesn't control outright. More comprehensive view of economic performance.
And he distinguishes economic goodwill from accounting goodwill.
Big time. Recognizes that the real value of intangible assets, brand, reputation, might be very different from what's on the books.
So don't just rely on the reported numbers. Understand the underlying economics.
Definitely. He even says to ignore certain charges, like amortization of goodwill from acquisitions, when you're evaluating the true economic performance.
Okay, nearly there. Executive compensation. How's he think about that?
Alignment. True alignment. Executives should be partners, sharing in the upside and the downside, not just heads I win, tails you lose.
Makes sense. And pay should be based on
Results they actually control. The performance of their specific business unit, not just the overall Berkshire conglomerate result. Reward relevant performance.
fair. And finally, the giving pledge. We mentioned it, but it's worth emphasizing.
It really is, pledging over 99% of his wealth. It comes from gratitude, he says,
Yeah.
recognizing his luck, wanting to give back effectively.
Ensure the family's needs are met, then return the rest to society. It's a remarkable commitment.
It truly is. A powerful statement about wealth and responsibility.
If you like what you are hearing from us, please subscribe.
Also, if you would like and share this video, it helps us tremendously and means so much to us.
Please also leave a comment. We want to know what you think and value ideas you might have for future podcasts.
Thanks for tuning in.